the market's really robust. It helps also that the venture capital industry has continued to stay very consistent, over $170 billion invested in 2023, which, if you take out 21 and 22, is really kind of a record-setting year. And so the market's robust. There's a lot of activity. Good companies continue to receive funding, and Trinity Capital is really poised to be a lender to those companies. So it was a great year.
What were the most popular business segments that saw the most growth?
So, software continues to be kind of the strongest point for venture capital investment, receiving somewhere in the realm of 25% of all venture capital dollars flow to software still. Biotech and pharma, significant investments in that space, which is really interesting. In the healthcare and life science space, valuations had really kind of reached a low. And so it's been a great time to jump into that space as well. And so you're seeing a lot of investment into AI. And we haven't participated in a lot of the company investments there. We've taken more of an approach of financing equipment and really kind of taking a one-step separation from that newly developing industry.
Do you think you guys would get deeper into that industry then as the year goes on and people find more tangible, proof of them being able to actually use AI and churn out a product?
Yeah, so we're focused on growth stage companies. This is going to be more kind of like pre-IPO type businesses who have received significant capital investment, but who are also really at scale from a revenue standpoint. And so to the extent that companies get to that point, absolutely, we'll participate in that space. For now, I think it's early innings. We're going to see some winners there, and we're going to see a lot of losers as well.
Now, I can imagine you guys are also keeping your ear to the ground about the path of interest rates this year. Now, how does this changing macro environment with potential Fed cuts, how are you guys advising the folks that you interact with around this, or how are you moving around when it comes to this as lenders?
So a couple things. I think we're expecting maybe some rate cuts later this year. Certainly not significant rate cuts. I think the environment that would exist where you saw significant rate cuts would be a really negative economy. And so we think that we're probably looking at some relatively small rate cuts and maybe starting Q2, Q3. The way it impacts our business and the companies that we invest in, most of the companies we invest in I would say, are lightly leveraged. So our typical loan to value is more like a 10 to 15% loan to value, a little bit different than your middle market companies that are a little bit higher leveraged. And so the immediate impact to our companies, even as rates increase, was not significant. The way we have set ourselves up to really benefit in the event that rates do get cut is we have floor rates that are significantly higher than our peers, at a position where if rates do decrease, we might see our corporate cost of capital decrease, but our loans actually stay the same. And so there might be some margin and some benefits that we would see as a company. The companies we invest in, the benefit to them would be maybe a little bit longer runway. For those that are still burning cash, they're going to end up seeing a less cost of capital for their debt and a little bit longer runway for these companies. So there should be some benefits to them. And then you might also just see money to start to flow a little bit more. And so there might be some more options for capitalization as rates decrease.
High dividend yields and lucrative stock opportunities await, but only if you act fast. Welcome back, viewers, to InvestMinder, your source for actionable investing tips to help you reach your money goals faster. Today, we've got 3 premium dividend stocks that can supercharge your passive income portfolio. With double-digit yields ranging from 12% to 15%, these stocks won't stay under the radar for long. Stick around as we count down our top 3 high-yield dividend finds that you need to consider buying now before the window of opportunity closes. I'll outline everything you need to know about these stocks along with the dividends they offer, their financials and growth prospects, and reasons why these generous dividends could be cut if you wait too long. After watching, you'll be fully equipped to decide where to start staking a position in these dividend gems as part of your asset diversification strategy. By taking advantage of these earning-boosting opportunities now, you'll be laying the foundations for a prosperous future fueled by the passive income of your investments. So without further ado, let's jump into our number 3 pick. Number 3. Coming in at number 3 on our list is Brandywine Realty Trust, a massive publicly traded real estate investment trust focused on urban workplace markets. With properties centered around Philadelphia, Austin, Washington, D.C., and other growing metros, Brandywine yields a generous dividend currently at 15.23%. As a real estate investment trust, or REIT, Brandywine is required to pay at least 90% of its taxable income as shareholder dividends. This structure, combined with the company's steady tenants and high occupancy urban office buildings, allowed Brandywine to maintain dividend payments every quarter, even when many REIT dividends were slashed during 2020. The stock trades at just 18% of its 52-week high after significant pressure on office property valuations during the pandemic. With strong demand for centralized workspaces as employees return to offices, Brandywine is poised for a multi-year recovery. Pre-pandemic funds from operations consistently topped $3 per share, supporting dividend coverage of around 5%. Upside potential is further boosted by Brandywine's robust development pipeline, including over $800 million of projects underway scheduled for delivery through 2026. As these properties come online with long-term tenants, dividend growth could accompany the stock's rise back toward 52-week highs. Number 2. Our runner-up for today brings us to the world of business development companies, which provide financing to small and mid-sized firms typically overlooked by banks. With exposure to over 200 companies across industries, PennantPark Investment Corporation yields over 12% for investors willing to accept additional risk. As a regulated investment company, PennantPark must pay out 90% of taxable income to shareholders. This allows for stabilized high single-digit base dividends covered by investment earnings, plus periodic special dividends funded by one-time gains from early debt repayments or equity sales. PennantPark's investment portfolio exceeded $1 billion in fair value as of last quarter, demonstrating increasing scale and diversity. The company also has over $300 million of available liquidity through leverage capacity on existing credit facilities. This dry powder positions the BDC well to fund new investments, while leveraging opportunities exist to magnify portfolio returns. While economic uncertainty could negatively impact some existing investments, Pennant invests primarily in floating rate debt, which increases in value during rising rate environments. With a decade-long track record of reliable dividends, new investors can take advantage of PennantPark's inflated yield today, before the Fed pivots and markets recover. Before revealing our number 1 dividend pick, it would be amiss to not at least mention 2 other high-yield standouts that just barely missed making the top 3. First is Arbor Realty Trust, a specialized lender financing bridge loans, mezzanine debt, and more for multifamily, single-family rental, and commercial real estate assets. As a mortgage REIT investing in higher-risk credits, Arbor employs leverage to juice shareholder returns. Impressive portfolio growth in recent years combined with leverage and distress opportunities during COVID have allowed Arbor to reliably fund dividends now exceeding 13.5% annually. However, if the economy dips and credit conditions weaken, dividend coverage may become questionable despite cheap valuation metrics today. Our other honorable mention is Barings BDC, an investor providing capital to private equity-backed small and mid-sized entities. Barings distinguishes itself by leveraging the research and relationships of a $327 billion global asset manager to source rewarding risk-adjusted opportunities often out of reach from competitors. The BDC's floating rate debt investments again perform well in rising rates environments, allowing Barings to fund an 11.4% dividend consolidated across monthly, quarterly, and supplemental special payouts to meet RIC requirements. But BDCs live on the equity, debt, and capital markets, and turbulence in any of them flows downhill to dividend coverage ratios. Both picks deserve closer inspection for investors hunting for amplified yield. But questions linger whether such lofty dividend levels built on leverage are sustainable if the economy continues heading south. And now let's go to our winner of the list for today. Number 1. The creme de la creme of high dividend opportunities, Trinity Capital, a specialized financing provider to venture growth stage companies. Clients range from tech startups to life sciences innovators, with Trinity's expertise and relationships setting them apart from generalist lenders. The firm earns its leading 14.29% dividend yield through interest payments and equity kickers received from its differentiated client base. Structured as a regulated investment company like PennantPark, Trinity pays out essentially all taxable earnings to shareholders through monthly dividends. Rapid growth of its diversified $1.5 billion debt and equity portfolio also creates large one-time dividends, like the 45 cents per share special dividends last year. With total investment originations exceeding $1.1 billion over just the past 6 quarters, Trinity is hitting its stride in deploying available capital into promising growth companies. Given the unreliable market environment, startups will continue relying on niche financing providers like Trinity to fuel their visions, and shareholders are richly rewarded by the associated rising income streams. Of course, economic turbulence or trouble in Silicon Valley may cause occasional repayment issues or valuation write-downs, but Trinity's multi-year venture debt terms and varied equity exposure helps smooth volatility while keeping dollars flowing to Main Street investors through ever-increasing dividends. And there you have it, our top 3 picks for dividend stocks with yields of 12% or more for generating prolifically growing passive income. I realize that chasing high yields can sometimes end poorly if an economy stumbles. But with careful analysis, these generous and reliable dividends can greatly accelerate your wealth-building journey. Let's do a quick recap on why Brandywine Realty Trust, PennantPark Investment Corp. And Trinity Capital offer once-in-a-generation income growth potential that needs to be seized now, before windows close. Brandywine presents landlords with the opportunity to capture an outsized yield today from undervalued properties concentrated in enduring innovation hubs. Buying at cyclical lows could position investors to gain not just 15% plus annual cash flow, but price upside back near 52-week highs. PennantPark exposes shareholders to 200-plus small and mid-sized businesses through credit and equity funding levers unavailable to banks. While higher risk, juice 12% plus base dividends and periodic special payouts offer enticing rewards. Trinity uniquely banks on the economy of tomorrow by financing high-growth startups. With differentiated capabilities backing its 14% yield, Trinity has delivered reliably increasing income to shareholders even amid recent turbulence. As always, be sure to carefully weigh risks before hopping aboard any single investment. But used judiciously as part of a balanced portfolio, all 3 picks can turbocharge your dividend income. I hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.